And
All
that
right, we're
so let's get on. Let's do this.
let's do it.
Okay, once you
All
see
right.
the live icon in the top left, you can go ahead and start. Let's do it.
Very exciting. I love your thing. All right. Welcome everybody to another episode of Ask the Expert with the March and Eiden team. Today we have Mark Stein of Wells Fargo with us, mortgage broker. So as you know, the month of May, which is traditionally a big buying season for buyers, we're focusing on buyers. Last week, we had a bit of a roundtable with our two big sellers on the team, Whit Prouty in LA, Alex Magoob in New York. Today, we're going to be talking with mortgage brokers and then, or a mortgage broker, the mortgage broker, I should say, right? And then next Thursday is going to be a real estate attorney, Gary Katz, to kind of give us the thing. So tell us what's going on, Mark. Give us a little bit. I mean, I usually started out like, can you come back? Can we go back a little bit to 2020? How did, it was just such a crazy year. Q1 things were happening. Then there was a slowdown. How did all the banks, what happened last year? Can you give us a recap?
Yeah, absolutely. Thanks for, allowing me to join here. It's a great opportunity just to kind of let everybody know I've been with Wells for 16 years, been in the industry about 20. Last year was, very challenging year because the banks, decided to pull back on a lot of policies. Granted, we just didn't know how much impact it would be to our borrowers, whether they're going to lose their job or, not be able to pay the payment. So the government came in and allowed customers to pause their payments, which did cause a lot of the policies to be pulled back, even the loan to values across the country, which means that buyers had to put down more money to mitigate risk for banks' balance sheet, our balance sheet, et cetera. So there was a lot of changes that occurred in 20, and we had to navigate through that so much so that we would help buyers still purchase properties during 2020. I know we did a lot of refinances, but still a good amount of buyers came to the market, and we just helped them, and I helped them just to navigate through all those policies, even though that they changed, that is, and still get them to the finish line. So it was much more challenging in 2020, but we still were able to close them. Rates still were very reasonable. They came down because, the whole stock market dropped. Everybody wanted to go into safe zones. So the rates still stayed very, very low for customers to consider purchasing, because maybe they would actually get a great deal on a house or an apartment. So that's, that was the opportunity for somebody that wanted to jump in 2020. So, the activity was there, more refinances of course, but there's a lot of buyers out there that were looking for a deal because they knew, people wanted to get away from metropolitan areas. They wanted to go into the suburbs. So we saw a lot of that. And leading into 2021, it's starting to see that people are starting to feel more comfortable with their finances. The market now is at an all-time high. And you're seeing the activity now. It's just like a big push for metropolitan areas, the consumer confidence, et cetera. So, there's a lot of money that's in the system right now, keeping rates very low. It's a tremendous opportunity right now to purchase or even refinance, even if you have a mortgage,
right?
Take advantage of that.
That sounds great. So now what we're like, so I just want to go back for a second because, people heard some restrictions, minimal credit score higher. Have the banks, have they kind of pulled back on those restrictions that they initially had, or do some banks still keep them, or what's kind of the update with that?
So a lot of the policies were retracted actually recently, like the last few months. For Wells Fargo, I mean, we retracted a lot of those type policies. Loan to values. I mean, across the, the country, we classified a lot of the values as like much lower, like we just saw some depreciation happen. But now it's totally turned. And now we're seeing that it's, increase in values. The demand is very high for mortgages as well as purchase volume. So those things that have helped us change those policies back to normal prior to the pandemic. So that is, that's the key component for a perfect storm for any type of real estate agent, or if somebody who's buying in this market that is looking to put down 20% up to $3 million. I mean, that's tremendous with low rates, that you can, borrow as much as you can up to 80% and still hold on to your other cash and, invest it in other parts of and diversify pretty well.
That sounds great. So I think that's really helpful. So buyers that were, for whatever reason decided not to buy last year, it may be a blessing in disguise for them that while perhaps purchase prices are up a bit, your loan to value ratios are now more in your favor and you can borrow. And like you said, a lot of people will borrow because they can make a higher return on other investments and borrow against it. So that's the other thing. Everybody always asks the mortgage brokers, what are the rates? What are the rates? What's going on, right? So last fall, I think was arguably the lowest, and please correct me if I'm wrong, was super low, and then rates are up a bit now, but still historically we're super low, right? Or kind of give us the scoop of what's happening.
Yeah, I mean, it's I think late, I think January was a very, a point where the rates were just tremendously low, and a lot of buyers were able to obtain those rates. Then I guess late February, going into March and part of April, we saw an increase of the yields, which caused mortgage rates to climb a bit, like maybe a quarter to 3/8 on those rates. But then as we got closer to the end of April, we saw there was some data that came out from I would say the Federal Reserve and where they think the rates are going to be, inflation. There's so many factors that go into mortgage rates and and how traders move money, whether it's into bonds or not. So it's just mortgage rates actually kind of now have come down a bit and have flattened, is what I've seen. I'm still, we're still competitive on a 30-year fixed jumbo rate, 3% on the note rate, an APR of 3.048. That's kind of like where your jumbo rates are. And a lot of buyers can take advantage of Wells relationship pricing. So what we do is, we have tiers that customers can actually get even lower on their mortgage rates by bringing over assets to Wells, whether it's an IRA or brokerage account that could be transferred. Our relationship starts at $250. It's an eighth off the rate. $500 is a quarter. $750,000 is 3/8, and $1 million takes a half off. So if you can imagine borrowing dollars, you can get discounted by 0.5%. And that still saves the borrower a tremendous amount of money over the years by just transferring over assets. So those are kind of like a key component of our selling ability and of course beating the competition on the streets.
Right. So you're saying you could have a 30-year jumbo fixed at 2.5% if you bring over $1 million.
Correct. Yeah,
that is insane.
Correct. And most people, that are buying in, let's say in the metro area, they're not really taking 30-year fixed. They're mostly taking like a 7 or a 10-year ARM, because most of the time they think about, the future, and they might want to go bigger or maybe move into the summer. So we do see much lower on those rates. So there's a lot of products that are out there: the 7, the 10, the 30, the 15, the 20. So there's
so let's maybe touch base on that for a little bit with buyers, right? So the traditional, when somebody thinks of a mortgage, the traditional is the 30-year fixed, right, where you pay off the mortgage over 30 years, and then kind of maybe give us a little bit of color behind it of how the other things came into play and how they would be perhaps a better product for buyers out there now.
I mean, a 30-year fix is like, if somebody was, looking at it in the suburbs, I think that's like kind of like the go-to. It's conservative. It's a conservative approach. I sell more of those in those metropolitan, in the suburbs. Single family homes. They just want to have that comfort level, knowing, their payment's not going to change. The only thing that really changes on their payment is if their taxes go up or their insurance. That's the comfort level to going to a 30-year fix. Now, when I see customers taking a 7-year ARM, what is that? It basically means that the rate is fixed for 7 years. After that, it could adjust every 6 months. So there is some type of risk behind that for buyers. So you have to either be willing to sell it within that 7 years, or refinance within that 7 years, or allow it to adjust. And if that period is higher than standard rates at that time, then probably you would want to refinance to lower that rate again. And then the same thing with the 10-year arm it's fixed for 10 years, and then it'll adjust every 6 months after that. So you have to look at either selling, refinance, or look at the adjustment rate at that time. So it's really kind of preference and your risk tolerance of taking that product.
Got it. So in other words, like the 30-year fixed is sort of, this is going to be my forever house in your mind's eye. I'm going to be parking here for 15, 20 years, 30 years perhaps, and I have I'm a standard, is it W-9? What's the one that you're on the salary? Is that W-9 or W-2? I get those confused.
W-2 if it's a salary.
Yeah. So if you're a W-2 person salaried, and you have a set amount of income, the 30-year fixed may be a good idea. Now, and I find this with a lot of clients as well, that they have a base income, but they have a really high bonus. And they have said to themselves, and most buyers that I work with, in their course of buying, they usually have they go from 3 different homes in kind of the first 10 or 15 years. The first one is the starter property, 1-bedroom studio or small 2-bedroom. Then there's, you find somebody, maybe a kid comes along, you move up to a large 2 or a 3. And then perhaps more kids are along, or you need 2 home offices, or you want bigger space to show that you've made it. So that's kind of your big home, right? So pragmatically, people are not staying in their places for 30 years. So this is where the 7-year, 10-year, is that automatically IO, which you're paying interest only, or are you paying down the principal on that? Go ahead.
Yeah, you bring up a good point. I mean, that's a total different product. Like we have the 7-year arm and the 10-year arm and the 30-year fixed. And then what you just described is if somebody is like heavy bonus or commission and they get a good chunk either quarterly or monthly, then we can look at the interest only product. I mean, it's not for everybody. Those policies are strict. We do want to see a good level of assets and income, and that is just the interest only payment required during the term of 10 years, because it's only 10 year of interest only, and then it becomes fully amortized after that. So for example, somebody can take a 30-year fix and ask for an interest only period for 10 years. We have that product. And then what that does is that if you take out a $1 million mortgage and the customer does not pay down that balance, then by the time year 10 is done, we amortize that payment over 20 years because the term was 30 years. So you'd have to be ready to make a higher payment come like after 10 years, basically. And the adjustable rates, yes, the interest only period is for 10 years, but you have that adjustment periods on the 7-year arm for the next 3 years. It'll still be interest only, but you got to look at the interest rate. Is it worth refinancing into another 7-year IO or a 10-year IO? So those products are, for bonus, like you said, bonus or commission is what I see.
Got it. That makes sense. And that's with the interest only. And that way, if you're on you have a set, quote unquote, smaller set income, but you have big bonuses, you can pay down the principal, correct? If it's an IO,
correct.
Or
yeah.
Right? So that's another nice feature. Go ahead. I'm sorry.
It's a good cash flow way of approaching this, that you don't have to have that large payment on a fully amortized payment, and you're just taking the interest only just to have cash flow for other things that you need to pay for.
Right. And that also probably would be helpful if you're not again, if it's one of those first time buyer or in between places where you're not going to make it your forever home. So other things are let's say for first time buyers or someone that hasn't been in the market in a number of years, what are things buyers have to get prepared for to give you for a mortgage, and how does all that work?
So now today it's all like digitally, everything. I can send you our online link to fill in all the data that you know better than I do. Your address, your social, date of birth, your employment, how much you make in income. That's where you start off with the process, is just getting the data, receiving the data from what you entered, and then asking for the documentation to support what you entered. Because you're more secure when I'm able to review the documents and support the data that you entered. Because once I decision that loan, the system's going to say, do you meet policy? And if you do, we can issue that pre-approval. If you don't meet the policy, then I have to automatically submit that loan to underwriting for a decision. So it is critical for when somebody wants to come into the market to really, get into that application and get pre-approved. And if you're not pre-approved, just get the loan submitted to underwriting so that we can actually make a decision on your finances, whether we'll approve the loan or not, or maybe come back and say, you only qualify X dollars. So, we're going to look to see, how much we can lend to you and navigate you through the process. I mean, everything is all about navigating through the complexity of this process and smoothing it out for those borrowers. And that's just, that just comes from experience, like myself. I mean, I just know how to just navigate through wells just because I've been through it so many times. I know
and it is a labyrinth, right? It is a real labyrinth. So that's, I mean, I was just gonna, I mean to cut you off, but it is really nice that it's a portal, right? So it used to be, send me all these documents and I'll have an admin collate it and get back to you. It's now a very simple portal to have everything put in. What are some of the problems that you see coming up? Like I always think of, somebody thinks they have a great credit report, but they forgot to pay a phone bill 5 years ago, and now it's dinged them or something. What pitfalls do you suggest for buyers to avoid, or have you seen that? I guess that's the open question.
In terms of credit, I see this a lot where, people just wait on their credit cards or credit bills. I mean, I always kind of tell them, pay them before the bill comes, and I think that's going to see a much different, or, I mean, I'm just giving an opinion towards, credit, et cetera. But I do see, some people are not aware of a medical collection, or they're not aware of, something else that's on there. But I mean, I'm here just to pull the credit and kind of give you an update of where the credit score is. I mean, I can give you my thoughts on, what I see and give you suggestions on what I think you can do. But I think most of the time I've seen, very good credit. People are paying their bills on time, which is good. We have seen, people that have paused their payments. It has not affected their credit score. That's a good thing.
Right.
It's just that they were in forbearance, but it had no impact on that credit score. We just have to get data just to make sure they're out of forbearance. But it's just, making sure that if you have some self-employment income and you don't tell me that, and we do find it out later, it just causes another delay in the process. So knowing as much information up front, tell me the story up front about everything, and it just makes the process so much smoother than either I find out or an underwriter finds out. It's just give me it up front, and the process is so much better, and you feel great because the customer is getting serviced. It was a great referral, etc. So that's just, those are the things that I have noticed over the years.
Okay, that makes sense. So the mindset that I would suggest for buyers is a shift, as opposed to, I'm nervous, am I going to get a mortgage or not? Instead, it's you're in partnership with them. Pull your financial pants down, so to speak. Let's see what you have, and if there's any problems, I'm here to help you correct it, because let's try to finally get you a mortgage. Does that make sense?
Yeah, I mean, that also separates all of us. I mean, just knowing what's going to work and what's not going to work. I mean, that's what you up front. I'll be straight up. I mean, with the client and the customer, and say, this is what needs to be done. We have to submit the loan, but this is my expectation of what's going to happen. And I also look up condos and co-ops. I look at their financials to make sure we're okay. It's not on a do not lend list. So I do a lot of legwork up front, so that way I know the deal is going to close. I don't want to wait for underwriting. I want to anticipate that up front.
That's great. And that also helps brokers a lot as well. So if you're a buyer and you see a property, when I represent sellers, I ask for a pre-approval letter citing the building they want to make an offer on. And then again, this is a quick recap on that. What you do is you make sure the bank will lend to the co-op or condo. Now, here in New York, you lend the vast majority of the time. But who knows? There could be litigation that makes it unlendable. There could be building violations. Who knows, right? So it's nice. The last thing you want to do is to go into contract with something that you can't get a mortgage on.
I know. And the other
right.
touch on that is, like, one thing that came up is, a proprietary lease was expiring less than 30 days. The bank's loan is a term of 30 days. So you have to make sure they're, more than likely they're going to extend it. So we have to get that information from the co-op management company or the lawyer stating that they are in process of doing that. Some banks will not approve those loans until it's extended. So just be cautious of that if the proprietary lease is going to expire less than the term of the loan.
Got it. Okay, that's really helpful. So what I wanted to go over some numbers a little bit. So the loan to value ratio. So for every $100,000 that you report, and again, you look at the gross income or the net income.
No, so you bring up a good point. So on W-2s, we go off of gross.
Okay.
Bonus, we look at the average of the last 2 years. So if you got paid a bonus on in 2020, we'll look at the bonus and average it out. If a lot of, I'm seeing a lot more RSUs, which is restricted stock units vested every quarter. So what the bank does is take an average of the last 2 years of the stock price and then look at the amount of shares that are vesting or have vested in the year to determine what that income will be going forward. And then, of course, the RSUs, as long as you're getting grants and you have grants in the past, that's continuation of income. So that's like kind of one bar that, that I have done. And then for self-employment, it's all about cash flow. Cash flow is the bottom line. It's net. It's what the borrowers are putting in their pocket. So it's much different for a self-employed borrower, a W-2 borrower. So a self-employed borrower, it's all, a distribution for, any type of depreciation I can add back. There's a lot of different factors going on in self-employment, a 1065 or 1120s. Like, we have to analyze that to determine what cash flow we can use to qualify for the mortgage.
That makes sense. And that's, on a side note, or not a side note, but that brings a really good point. A little bit of battles between your accountant and your mortgage broker when you want to borrow something, right? So let's say, I have a company and my company grossed 500,000 last year, and your accountant says, well, that's great. We can deduct all these things and have your personal returns come down to $100,000. I can write off, I'm making the numbers, I can write off 400,000, whereas, you're living a lifestyle of $500,000, but you're only showing 100,000. You come to the bank and the bank says, we can do a loan to value over what you reported, which is 100,000, right?
Yeah. Like, so, you're at like $8,000 a month. So you're able to borrow as much compared to somebody that, shows $400,000 or $500,000 as your net.
Right. Absolutely. So that would be something, and for those of you that are in that category, then you may have to decide that you want to declare a higher income. You said it's a 2-year average. You guys look back at 2 years, right?
Correct. We look at 2 years of self-employed income. Last year was kind of interesting because it's, hopefully, we're behind us, but the banks are using, 2020 because 2019 was probably much stronger than 2020. So you have 2020, which could be much lower. We look at the profit and loss to see, if they've gotten better from 2020 to 2021, but we're still most likely going to be using 2020 to qualify as a conservative approach.
Got it. Okay, that makes sense. So for every, what is the loan to value right now? Let's say I make $100,000 a year, which is whatever, $8,300 a month. How much does Wells allow me to spend on a mortgage with that, and what does that translate into borrowing dollars roughly?
So like on
The math
$100,000,
quiz.
yeah, $100,000, you probably can borrow roughly about 4 to 450 is my guess, to be within a good
Okay.
ratio, debt to income ratio is what we call it.
Okay.
So you have to be careful because you just don't know how much the taxes are, what's the maintenance. Like I have to ask all those questions up front because that could have an impact on your loan amount based on your final common charges and taxes. So I'd say 400 would be ideal. So that's why you have to be very careful of how much you truly write off. And if you want to borrow more, you have to make sure you're aware of that.
Got it. So roughly for every 100,000, you can borrow 400. So just multiply that out. I think that's really helpful.
Yeah.
And then what would be the payment on that roughly?
Roughly, I would say, I hate giving rough numbers.
You can do the guess. Yeah, I didn't mean to put you on the spot on this, but it's always kind of fun for people to have these.
I mean, I
Right?
would say probably roughly about 2,000 is my guess, just because the rates are so low.
Okay. Okay.
But don't quote me on that if being recorded. So
Yeah, no, I hear you. These are all like, mindsets for people to. So again, these always go so fast. Do you have any closing thoughts or ideas or things that we missed or insights you want? Go ahead.
For to close faster, like I said, just follow our online portal. We just send us docs when we ask for it. Like sometimes people just don't send it immediately. If they send it immediately, we can get these loans in faster and then they get approved a lot quicker. I mean, I had a recent loan where the customer was so on with our online portal. She followed my instructions. We got the appraisal done in 2 weeks and we closed her loan in like 20 days. So it doesn't happen for everybody, but it's really, the faster information comes to us, the faster we can get it into underwriting, and then underwriting can put the loan in queue to be underwritten within that 5 to 10 business days is a normal turn time in this type of market. Okay.
Well, that's great. Well, thanks a lot, Mark. I really appreciate all of your help today. Mark Stein with Wells Fargo giving us the insights for May here with buyers. So thanks again for joining us on Martin Eiden with Ask the Expert. Take care, everybody. Hold on a second, Mark.